Are UK homes castles of sand? I asked in the last video. And by the way, if you haven't watched it, well, you probably should. In this video, I ask a different question. How do we price UK and specifically London property? Apologies in advance. This video is less a polemic and more a valuation exercise. So, without further ado,
I needed money 'cause I had none. I fought the law and the law won.
this is Hampstead. It used to be the preserve of artists, but is now overrun by hedge fund managers. It's also a thinly traded property market. When an estate agent, realtor to our American friends, gets property to sell, he uses his intuitive grasp of supply and demand economics and prices. It's a little bit above what he thinks it's worth. The biggest factor in deciding this, by far, is the price at which other similar homes are sold at. And when John J. Jones, international corporate investor banker man, comes looking to buy a house, the biggest factor influencing what he pays, again, is the price at which similar properties are transacted. The bank lending the money, the buyer, the seller, and the estate agent all rely on the market to tell them what properties are worth. There's only one problem here, and that's that there simply aren't many transactions. The number of people who have £5 million to spend on a 3,000 square foot house is not a large one, and there aren't many sellers either. So the number of data points that contribute to the price is remarkably small. With that background done, let's do a quick segue to valuation basics. While at university, a friend of mine called Laith Ishaq recommended Introduction to Corporate Finance by Brilliant Myers. This is, or was, the textbook for those looking to grasp the basics of finance. In it, the value of a company's shares is defined as the discounted flow of dividends. What does that mean? Well, say you own shares in Industrial Corporation Inc. and it pays a £5 dividend every year. What's that flow of dividends worth? Well, you start with the discount rate. You see, receiving money in a year's time is not the same as receiving it today. Would you rather get £5 today or £5.25 in 12 months' time? If you're indifferent, i.e. the two are of equal value to you, then that difference, percentage-wise, is your discount rate. So let's go with that 5%. The £5 in dividends industrial company will pay us in a year's time is only worth £4.76 today. And the payment in 2 years, just £4.54. Eventually the sums, the £5 you received in 100 years or so, becomes so small as to be meaningless. A share of Industrial Company Inc., as the graphic behind me shows, is worth, depending on exactly when the first dividend is to be received, somewhere between £100 and £105. Now, the real world is uncertain. Industrial Company Inc. might make a terrible investment in a factory to make whalebone corsets and end up going bust. Or it might make a brilliant one in a new line of children's toys and dividends might soar. As the future dividend stream is uncertain, so is the value of the company's shares. How does this relate to housing? Well, a company's shares are productive assets. They kick out, hopefully, dividends. A corporate bond is a productive asset too, throwing off interest payments from time to time. A barrel of oil is not a productive asset. It's just a barrel of oil. It generates no income stream. But a house? Yes, a house is a productive asset. If you're a landlord, it kicks off a stream of rental payments. So when you own a house or a flat, you own a productive asset. And if you live in it, you're doing even better. You see, when a share pays you a dividend or you receive interest from a bond, well, that's income and you're taxed on it. When you receive the benefit of somewhere to live, that's untaxed income. There's a name for this benefit. It's called imputed rent, and it's captured in GDP numbers. So if house prices rise 25%, then imputed rent rise similarly. And my goodness, the economy is bigger and people are more productive. Did I mention productivity was a really stupid statistic? Let's bring this back to housing. The way to calculate what a property is worth is exactly the same as with any productive asset. We discount the income stream. And fortunately, we know how much properties rent for. So let's make our customary trip to Zoopla. And because it makes our point best, we're sticking with Hampstead and one of its most fashionable streets, Templewood Avenue. Here's a large and attractive two-bedroom apartment that rents for £2,730 a month, or £33,000 a year. And what's it valued at? Well, Zoopla reckons two-bedroom flats on Templewood Avenue are worth somewhere between 1.5 million and 2.5 million. Personally, and this may just be me, I wouldn't pay 2.5 million for an 850 square foot apartment in Hampstead, but that's not the story. To make the numbers easy, we're going to say that this property would currently transact at £2 million. So the implied rental yield is 1.6% per year. Seems pricey. Let's look at the yields for other assets. 10-year UK government bonds yield 1.3% a year, so it's a little better than that. The FTSE 100, i.e. the index of the largest companies in the UK, gives you, wait for it, 3.9%. But while property is better than shares in some ways, it's worse than others. You see, if I own shares in, say, Royal Dutch Shell, then they mail me dividend checks from time to time. There's no cost of ownership. Every house or flat, no matter how nice, depreciates and needs maintenance and occasional renovations. There's the cost of insurance too, and if I'm a landlord, I'll also have voids. One day, no matter how well maintained, it will probably require rebuilding. A 1.6% gross property yield is probably only 1.4% at best in the real world, once we account for these costs of ownership. Now, it may be that Hampstead is just a bubble. It is. But let's see how far it spreads. Let's head back to Crouch End, where our fictional former flat owner from the last video was buying a terraced house for £1.1 million. How much would that cost to rent? Well, here you go. It will cost you approximately £24,000 a year, which is probably rather better value than the two-bedroom apartment in Hampstead. That £24,000 is the gross yield, however. Once you include the cost of ownership, which don't scale linearly with price, the net is probably less than £20,000 per year, so your real yield is only 2%. Now, these numbers are relatively extreme. Rental yields are lowest at the high end and in places where property has recently shot up in value, such as Crouch End. For London as a whole, gross rental yields are probably a little bit above 3%. Now, what's the right rental yield to use for calculating values? Well, I would argue that the factors I identified in my last place, specifically lower net migration and demographics, are particularly important in London. But let's be generous. Let's assume that rents in the future will grow in line with corporate dividends. And let's also say that the cost of ownership, depreciation, maintenance and insurance are just 0.5% a year. That means we should want a 4.4% yield, which by a remarkable coincidence is approximately the rental yield for the UK as a whole. That would require a 40 to 60% correction in prices in places like Hampstead. That sounds inconceivable, doesn't it? But here's why I think it's likely. Firstly, sellers in these places, as discussed in the last video, mostly don't have mortgages. They're also older and are moving because the house is now too much for them, or because of illness or death, or they're simply trading down. Negative equity can restrict the supply of properties in much of the country. It will not do so in prime London. Secondly, a fall of this magnitude will not even take most properties back to historic levels of affordability. Behind me is the chart of London property relative to that of the West Midlands. And by the way, West Midlands property has hardly been the worst performing UK property market. This is not cherry-picked. Back in 2004, London traded at around a 60% premium. It now trades at a 160% premium. If the ratio returned to the level of 2004, it would mean a 40% fall in prices. Or let's look at earnings ratios. The ratio between the average London salary and home prices is 14.5 times. This is apparently a record, but there seems to be little information on historic London ratios. Median disposable income, after tax but before property costs, was £536 a week in London in 2017. That's about 20% more than the West Midlands, which hardly justifies the 160% price premium. If we were to take London back to average price to income ratios for the period to 2004, it would mean dropping the ratio to 6 times, a 60% fall in price. Thirdly, there's the argument that London is a global city and global cities are different and global cities are different. But they're not that different. Demographia produces an annual housing affordability ranking. Hong Kong property, it estimates, is the most expensive in the world, costing around 20 times local annual earnings. But other cities, with the partial exceptions of Sydney, Melbourne and Vancouver, are much more affordable. Singapore properties average less than 5 times median incomes. New York, Denver and Boston are all below 6 times. It's hard to make a case why London property should trade on more than twice the earnings multiple of Singapore or New York. My prediction then is a bold one. I expect that prime London property will fall close to 50% in real terms in the next 5 years. Suburban London will drop a little less, while the southeast and what might be described as commuter land will likely come down 20 to 30%. And I expect stagnant real prices in much of the rest of the UK. A fall of this magnitude would bring 3 different measures all back into alignment: rental yields, earning ratios, and the gap between London and the rest of the country. Now, this video has somewhat inevitably ended up being longer than I planned. Before I go, one thought. There are some who believe falling house prices bring only benefits to the UK economy. For those in their 20s who've been unable to buy in London or South East, they will be a boon. But there are negative consequences. More than half the £5 trillion of equity tied up in UK homes is in London and the South East. Falling house prices will destroy a lot of wealth and savings. From an employment perspective, new building work is likely to slow. Recent buyers can find themselves trapped by negative equity, reducing labour mobility. And the banks who gave mortgages at high multiples of income at the top of the market will have problems too. Historic housing price falls have resulted in declines in credit availability, affecting gross capital formation for the economy as a whole. But these are issues for another video. Thanks for watching, and please click subscribe if you haven't already done so.
Breaking rocks in a